So to start out, first, I am the founder of Running Oak Capital. We launched an ETF. I won't mention the ticker at the moment because I want to be able to share it broadly, and I can't if I mention the ETF ticker. Um, but we launched an ETF 3 years ago, and according to many, had one of the best launches ever, certainly for a boutique firm. It grew from 2 million to 350. It's actually over 400 million today. And one of the reasons why it grew so rapidly is because the strategy was not new. So the ETF was new, but there's nothing new about what we were doing. And so when we launched, we had roughly a 10-year audited track record for the strategy. And then real-time data going back to 1989, the strategy's actually been run since the 70s. So it's been around. And over the initial 25 years, it performed 2.5 decades. It performed especially well. Outperformed the S&P by roughly 3.3% before fees, which is roughly top 1 percentile or so. And it did so, most importantly to me, with less than half of the downside. So at a time when Bogle S&P, this strategy outperformed it handily, and not only that, provided 3 to 4 times the return of the S&P given the same level of risk. And again, I did that for 2.5 decades. Now we launched the firm Running Oak, or I did, about 13 years ago now. And it performed especially well for the first 11 and a half years as either number one in the mid-cap blend space, or, I mean, at its worst, it was top 3 percentile over 11 and a half year period. And then that changed dramatically about 15 months ago now. So for about 14 months, everything that we intentionally invest in, and our strategy is very common sense. We want to maximize earnings growth while being very disciplined around risk and valuations. But in particular, if you're going to look at kind of the characteristics or the factors that we invest in. So profitability. Profitability lagged unprofitability. In other words, companies that lose money absolutely smoked companies that make money to a degree never seen in history other than 1999. High quality, which is largely companies that are growing, they're profitable, and they have reasonable amounts of debt or leverage. It's just well-run companies is generally how that's defined. High quality lagged low quality to an extent never seen in history other than 2021. And then low volatility, which there's a ton of studies show that low volatility is an excellent way to invest, not just uh, as an investor, because you don't want to be swinging around like a yo-yo. Um, but in general, lower volatility helps with compounding because standard deviation or volatility variability has a negative impact over the long run in performance. And so high volatility has historically not been the best way to invest. Meanwhile, high volatility is up 130% versus low volatility, which was up 12. Now, again, everything that we invest in, those common sense aspects, really struggled. And so for about 14 months, um, our performance was very different from the semiconductor stocks, which I referred to earlier, that were up uh, over 2x what the 10 highest flyers in the NASDAQ were up in 2000. So just to give a little bit of perspective, 25 years versus 11 and a half years versus 14 months versus 1 month. The last month was actually quite different. Now, this kind of illustrates the the difference in performance. And again, this is only 14 months. But you can see, and most importantly, the low volatility versus high volatility comparison. Again, low volatility is demonstrated to be a great way to invest. And that is there's barely a blip on this chart. Whereas high volatility, it's important to remember that high volatility isn't one stock, it's a basket of stocks. For a basket of stocks to be up 130% in a little over a year is nuts. But not only that, you can see that the factors that we invest in, which again are common sense over the long run, we'd expect companies that make money, high quality companies that are not on the verge of going bankrupt. Uh, we would expect that to outperform companies that lose money, companies that maybe are on the verge of going bankrupt, meme stocks and the most volatile companies, those kind of nonsensical factors were up 3 times as much as the common sense ones. And again, we invest in the common sense ones. Um, Now, I'm setting the stage because over that 14 months, again, we performed very differently from the market. Our portfolio holds right now 57 companies. They're equally weighted. They're mid-large. The universe is pretty similar to the S&P. And so for the most part, we'd expect it to be somewhat correlated. It was not. And just really quickly at the top, you can see on this chart the degree to which the 10 highest flyers in the NASDAQ recently just absolutely destroyed the 10 highest flyers during the tech bubble. It's not, there's a lot that many are pounding their desks saying that we're not in the tech bubble. And that's certainly true. There's a lot of differences. But, there's it still makes sense to compare historic periods of time. And the tech bubble is crazy. Bubble is in its name. And again, in the last year, uh, certain companies, the highest flyers have been up 2x that period. Now, at the bottom, this is what I really want to kind of set the stage with is, again, for those 14 months, common sense performed very differently from the AI trade, the things that were going up a whole lot. You can see that in correlations. So Russell Midcap, which I would generally consider us to be a decent, I'd consider that to be a halfway decent benchmark. Same with S&P equal weight. They were almost, both of those were almost 100% more correlated to SanDisk, which is sort of the poster child of this move. SanDisk is up 15% again today. I don't remember how much it was up in the prior year, 3,000% from, up to its highs. Um, you know, the S&P equal weight was much more closely tied to unprofitable tech as well as energy, and that really drove this move. Now, all those the most popular kind of AI companies that were really cooking, they seem to have sort of topped around June 23rd. And so that's the purpose of the second chart is to illustrate the difference in correlations. Uh, since June 23rd, our strategy or our portfolio has performed especially well. And it's because our correlation to SanDisk was negative 64% versus the Russell Mid, which was 50%. I mean, I never thought I would, I mean, we consider the Russell Mid to somewhat be a benchmark. Never would have thought that it would be on two completely opposing sides of correlation. That's really abnormal. Even the S&P equal weight, you can see that we are roughly 4 times less correlated than the S&P equal weight to SanDisk, which again is the highest flyer. Now, again, the title of this presentation was sort of the anti-AI trade, and I don't like thinking of us in that manner because I use AI. I use AI pretty regularly. I believe that AI will be transformational. It'll be part of our future. It'll be wildly, or at least some companies will be wildly profitable. But the market has treated us as though we're anti-AI, right? If you look at that 14-month period, uh, you know, certain unprofitable, highly volatile companies went straight up. Companies that we invest in did not. Over the last month and a half, the those same companies really struggled. We did not. And so the correlation, as you can see on the bottom right, again, has been negative. It almost rounds to -1, which would mean that we're the complete opposite. And again, that's not by choice. We will invest in AI when it pays, when it's profitable, which means we're just not investing in much of it right now. Now, this is now we're really getting to the meat of it that I hope really kind of my goal is to smack everyone in the face because it smacked me in the face. And I think this is such a critical um, factor to consider. Again, earnings, we're hearing about earnings all day, every day, about how amazing they are. On LinkedIn, on X, There's constantly these charts showing how cheap the market is now. And the metrics that they're looking at are based on earnings, right? So PE, maybe forward PE. And and so I find it really helpful to always get back to the simplest, come back to the absolute simplest terms. Earnings equals revenue minus expenses. Super simple. And earnings over the long run drive performance. Now, it can be very volatile over the long run as far as earnings and price performance. So over the short run, it can be volatile. Over the long run, though, they're highly correlated. Now, again, earnings equals revenue minus expenses. Let's look at revenues first. Revenue is wildly inflated, if I'm just going to go ahead and just sum it up. Uh, the amount that is being spent on this CapEx boom, on the AI boom, is roughly 5% of US GDP, which is an absolutely massive number. I mean, the US is by far, well, I guess you have China, but US is, the largest economy in the world, and 5% of it is being spent on this one t new technology that is certainly promising and is here to stay, but is thus far unproven as far as the actual applications. But 5%. Now, it's important to remember that that 5% has been driven by largely by the hyperscalers. The hyperscalers coming into this had a massive pile of cash, unlike anything seen in history, and that is gone. That pile of cash is gone. They also had positive cash flow, like nothing seen in history, and that is being spent entirely. There's a chart that recently came out showing that in 2027, that is quite negative. And then lastly, the hyperscalers are now selling a whole lot of debt. You know, they're really flooding the markets. And so all that's to say that that 5% of GDP was driven by a number of factors that are no longer existent, which is so it's going to be hard to repeat that. It's going to be it's hard to see how that's sustainable. Now, but it's real. Okay, so let's just say that that 5% is very much real. But the next part is circular financing. There's been some talk about it. I wish there were more because it's really weird. I think first and foremost, we should just all recognize that circular financing is not how business works. Business, when it's healthy, is a company offers a product or service at a price. And if customers feel that that product or service is worth more than the price where they can buy it, they buy it. It's super simple. It's not that complicated. Now, if it's so simple, why are companies like Nvidia handing customers or other companies cash in order to turn around and buy their product? There's two obvious answers. The first is either the demand isn't there. Why would you have to hand someone cash to buy your product if there's unlimited demand? That said, it does seem like there's a lot of demand. So then the second question is maybe the value is not there, right? So if you can get a product for less than it's worth to you, you'll buy it all day long. But no one is, right? They're being handed cash to do it. And really that's the big thing, likely, is that AI is just too expensive right now for most companies to implement. And therefore, NVIDIA and others have to hand them cash just to simply do it. And the issue is they hand them cash, they hand it back, and it turns into revenue. So again, you've got this massive revenue, 5% of GDP, then you're adding on a whole lot more due to circular financing, which is just again wildly abnormal. And it's worth noting that circular financing in numerous ways was deemed illegal in 2000. And then you have paper profits. So you stack on this massive expenditure, circular financing, now add paper profits. Google reported earnings a few weeks ago, and I'm not picking on Google because Google's actually in our portfolio. Um, Google reported roughly, I don't remember off the top of my head, let's say 115 billion dollars or so in earnings. 100 billion of that was paper profits. That's it's roughly 80% of what they reported was just paper profits. It's not real money. It's not money that they made operating as a business. It's equity in privately held companies that are burning cash like nothing seen in history, and then we're just marking it up. And it's worth noting that that's legal. That's accounting standards mandate that you do that. But again, it's not repeatable, it's not sustainable, it's not business. This isn't driven by business. And then lastly, tariff rebates. There's been a massive amount of tariff rebates that are also kind of pushing up earnings. And so again, earnings equal nothing more than revenue minus expenses. And this revenue number is wildly inflated by a whole lot of factors that are just kind of ridiculous, but certainly not sustainable. Now, let's move on to the other part of the equation, costs or expenses. Uh, because this money on this AI build up, because this money is being spent on investment, these companies are able to depreciate that which they're spending. Historically, particularly on tech like this, they depreciated it over 3 years. So over 3 years, let's say with $100, you are depreciating $33.33. But recently they extended it. A lot of these hyperscalers extended it to, let's say, on average 5 years. There's a little bit of a range, 4 to 6 years. Now, first of all, that has a huge impact. So if you the difference between a 5 year cycle and a 3 year cycle is on the you're you are realizing as an expense 70% more on the 3 year cycle than you are on the five. And again, the three was the norm, the five is what they've done. So it's a whole lot less that they're realizing per year. And it's worth keeping in mind, at least to me, that does not make sense because the world is changing faster than any time in our lifetimes. Technology is changing faster than any time ever. In fact, NVIDIA's chip cycle has gone from roughly 2 years to under a year, and yet for some reason they are extending the lifetime of these products, even though they're obsolete faster. So it doesn't make sense, but let's give them the benefit of the doubt. The impact that it has, regardless of whether it makes sense, is they're realizing a whole lot less in expenses. And the issue is, so let's say we realize 1/5 this year. That means that we put off 4/5. So now we've got 1/5 for each year for the next 4 years coming up. And then next year, we're going to do 1/5. And so that just keeps stacking up and piling up and piling up. These expenses aren't disappearing. And, it's really earnings expectations that drive uh, performance. And there's no reason to expect anything other than piling expenses because that's what's happening and therefore lower earnings. So right now, you're hearing this hype about high earnings driven by low expenses. Few seem to be considering the wall of expenses that's just building by the day, brick by brick. Now, then again, some must be because that is why probably the market appears cheaper and cheaper, is because some seem to realize that this is exactly what's going on. One other factor that's worth considering that's, again, nonsensical, but also makes this current environment less sustainable is profit margins. Historically, profit margins were one of the most mean reverting of metrics, largely because of competition, right? If you're operating at a hefty profit margin and potential competitors see it, they're going to come into the market and that's going to drive the price that you can get down due to competition and profit margins come back down. Now, that did change roughly around 1990. Around 1990, that's when globalization really started to sort of gain steam. And we were able to outsource to, areas of the world with cheaper labor. And then, you know, on the IT side in the US, we were able to, direct more resources to where it'd be better spent. And that drove profit margins higher. And then in roughly 2000, let's say 2010, 2009, uh, software companies really started, or software in general, really started to become a larger part of the market and of our world. And software is asset light, right? Like you create a software, maybe you have to update it a little bit, but for the most part, you're getting subscriptions. There's little to no marginal cost each time you sell it. And so that drove profit margins higher. And, if you'll remember over the last decade, uh, when value is really struggling in particular, many would say, "Oh, the market's overvalued," and the counter argument was, "Well, we're in an asset light world, and higher profit margins are here to stay." That has changed in 2024 due to a number, not just in the U.S. but kind of globally. De we started to see the reverse of globalization. We saw a little more nationalism. So one, we'd expect that to begin to hurt profit margins because the decisions as far as who's producing what is no longer solely driven by maximizing profit. It's driven by there's people have other interests. So that that would have a negative impact on profit margin. But also AI is asset heavy. So again, the argument for higher valuations and higher profit margins over the last decade was because software was asset light, tech was asset light. AI is asset really, really heavy. And you're building these massive data centers. Microsoft they had Windows. Everybody had Windows. For Microsoft to sell one extra Windows subscription cost them nothing. And it would just be basically free money. That has changed. We're now dumping obscene amounts of money into these data centers and into chips and everything else. It's asset heavy. Now, again, if you go back to asset heavy but globalization, that was that profit margin was roughly, well, it was roughly 6%. But even if we go to asset light, that profit margin was 9%. The average over that decade or so is 9%. Right now we're at 12.3. So a reversal in just simply profit margin, which means earnings, back to the last decade would mean roughly a 25% or so decline in earnings. And you can think about what impact that would have on price. Now, if we go back to the prior period, that would imply roughly a 50% decline in profitability or profit margin. And who knows? The world's changing by the day. It's this is really a gray discussion. But all that's to say that for us to be at historically high profit margins in an asset heavy time is crazy. Again, just going back to the earnings story, it makes no sense. So to wrap that all up and to quote John Bogle, and his relentless rules of humble arithmetic quote, um, it's just arithmetic. Actually it's just subtraction. Um, you've got wildly inflated revenues due to circular financing, due to paper profits and tariff rebates. None of those are sustainable. If anything, we'll probably see the opposite because they'll come out in the wash. Minus expenses, but we're talking 1/5 of the actual cost to create it, is creating this completely fake earnings number. And many are just not giving it the attention that it needs. And buying up, say, these semi companies, the semiconductor companies, or these construction companies that are building the data centers without thinking about this, right? It's not sustainable, in its current form. That does not mean that AI won't be transformational. AI won't be part of our future. It will. And there will be plenty of profitable companies, but we're just not there yet. And so, again, to wrap all this up, because this is what makes me excited personally, at least, is if you go back to the beginning of this, in many ways, we have been treated, and by that I mean running Oak, efficient growth, our strategy has been treated as though it's the opposite of AI. Again, if you look at this correlation chart on the right, our our correlation with SanDisk over the last month and a half or so has been negative 64%. Right? It's borderline the opposite. Russell Midcap is 50%. S&P is 40%, right? So the Russell Midcap is heavily correlated to SanDisk, to this AI play, to the semi stocks that have gone up 2x, um, the highest flyers in 2000. The S&P is tied to that. The S&P equal weight was 2x tied to that over the prior 14 months. It's been slightly negatively correlated to it. And then we've been sort of the opposite. Now, again, that AI trade, the the move in these tech stocks is driven by this earnings narrative, which makes no sense, right? It's wildly inflated. Again, it's just subtraction. Uh, the AI trade is based on earnings that are fake, driven by revenues that are wildly inflated and expenses that are one-fifth of the actual expense. Again, efficient growth is the opposite of the AI trade. We see that with the correlations. It's being treated as the opposite. Therefore, efficient growth is the opposite of this fake earnings numbers, the shenanigans that are going on. And therefore, again, this is just logic. If it's not equal to that, then it's equal to just simply being based in reality. And we've seen that in performance, both in a good way and a bad way. Again, over the prior 14 months, we lagged considerably when the frothiest of companies were going parabolic due to these made-up earnings numbers. And we've seen it in the last month plus where we've performed especially well while that has faltered. And so if you if this makes sense to you, if this simple breakdown of earnings and why they are not indicative of reality makes sense, we are a really good play to kind of be a ballast in reality. I mean, who knows how this all plays out? Again, AI is here to stay. I'm a believer in AI. I use AI. We will invest in AI when it's profitable. But right now, it it's unsustainable in its current form. And again, we're being treated as the opposite. So the opposite of unsustainable is sustainable. And I would just, I would recommend considering having a foot in both camps because there's no telling how this plays out. Maybe the AI craziness over the last 15 months resumes. If so, you know, the S&P equal weight has provided a shocking amount of exposure to that. The Russell midcap, anything that's long momentum could be an excellent play in that. And then for us, because we are very disciplined around valuations and equally weighted, we are effectively short momentum. Because we invest in companies that make money, we are a good counterbalance to that. Now, the last thing I'll say to really wrap this up is that it matters this matters more, the diversification and making a change or considering one now matters more than I believe any time before. If you go back to 2008, institutions had roughly 10% invested in alternatives, so in illiquid strategies. They had a much higher percentage invested in equities. Now, when the market began to decline and the economy began to struggle, institutions, because public equities were the best source of liquidity, they sold a lot. And that's why you saw that very significant decline in equities. And again, it, those institutions were more diversified, right? They had 90% in these liquids. It's not like they didn't have plenty to sell. Today, institutions have roughly 40% or so invested in illiquid assets. So they have a much smaller pool of public stocks. The average household in the US, last I saw, has roughly 30% more of their net worth tied to stocks than at the peak of the tech bubble. Um, Supposedly, roughly 60% of US markets is now passive, which is unheard of. That was, it was probably 5% 2 decades ago. And passive is now more concentrated than any time in history, roughly. So, say 40% or so is in 10 companies. So, again, you've got this massive concentration of institutions, of households, massive concentration in passive, and then passive is concentrated in 10 companies. If almost everybody owns the same tiny number of companies and they own a whole lot of them. And we all know what happens when everyone rushes for the exit at the exact same time. Moreover, if everybody owns something, who's there to buy it? And so again, that overcrowded trade, that concentration, which again, many on LinkedIn or whatever would have you believe that concentration doesn't matter. That is absolutely asinine. Everybody knows that if you have all your eggs in one basket and that basket drops, all your eggs break. So, if you have two eggs or two baskets, you're going to be a little safer. But, this concentration and then this made up earnings narrative and the frothiness that is tied to that, all of that is coming together to have at least keep an eye on and potentially consider using us as a diversifier, as a way to hedge your bets.